Your clients who probably want to sell everything, go to cash and ride this out?
Certainly, Brian. And what we're advising is it's never smart to panic. When you look back historically, and we have seen times of strife in this country, 1968, 79, we've seen some other election years that have been difficult. And our best advice is to understand your risk tolerance, understand how your portfolio is positioned, and make good decisions based on long-term investing versus the desire to knee-jerk on information. We're certainly stressed right now between the oil crisis, the pandemic, and now some civil unrest. It's not an easy time to be an investor. That's why we focus on quality, we focus on long-term, and making sure you feel comfortable with how you're invested. If you're too stretched, if you didn't appreciate how badly your portfolio performed during the downturn, certainly we'd look to trim some profits, make sure we're not too overexposed right now.
Oh, you are in Texas. I imagine many of your clients are in Texas. We haven't talked about oil a lot given the events of the last week, but let's be clear. It's up a couple more percent today. But at 35 bucks, Victoria, nobody in the oil patch is winning. I don't need to tell you that. So a lot of your clients are also facing in Texas this sort of quadruple whammy, if you will, where their portfolios may be heavily exposed to energy. What's your particular advice to them?
Well, so first off, we always allocate a client's asset based on their total portfolio. So for people that may have real assets in oil and gas royalties or ownership in an oil and gas company, we tend to not be too overexposed. You know, we try not to drink the Kool-Aid too much per se. So we certainly don't avoid energy. We think it's a good growth sector here in Texas. But, you know, look, it's going to be tough at $35 a barrel. There's certainly going to be people that go under. We're expecting potentially some industry consolidation and also some stress as we may see some of these banks all of a sudden have some non-performing energy loans in their portfolio. We want to make sure that we don't chase right now. You want to be looking at the quality energy companies. We want to be looking towards people who have the balance sheets or the capacity to open a line of credit and to make it through this. So I do think you'll see some of these stressed operators that were already leveraged struggle and potentially either go through Chapter 11 or look to consolidate in and have somebody buy them out. You know, during other times of stress, you've seen consolidation. Exxon became ExxonMobil, et cetera, et cetera.
Certainly, yeah. And so your advice to viewers right now, CNBC, that may have multi-million-dollar investment portfolios and multi-layered assets, talk to their advisor, like yourself, a G Squared, or whoever it might be, and say, what is all my exposure? What is all my exposure to energy? Am I exposed to some of these loans? There was a great story in the Wall Street Journal last night. I say great only because it was eye-opening in that many people had bought some of these exchange-traded notes that they thought were sort of safe income vehicles, only to find out that one morning they're redeemed and they're getting pennies on the dollar. Market structure is something we've talked about in this program for almost 2 years. You need to know everything you own, do you not? More now than ever.
Absolutely. And leverage is a very difficult thing right now. It's certainly, you know, trying to catch a falling knife or playing with fire. And you got to understand a lot of the big guys, the institutions, they don't touch the leverage loans like that for a reason. And so I understand it's exciting to get 300 upside and, you know, it helps to multiply. But if you're going to do that, please just keep it to a small part of your portfolio you're willing to lose, because you really are gambling at that point. You're adding in leverage. You may not fully understand how it works. And you've seen that also with the USO oil fund, where people bought into that and they didn't really understand how it worked and how exposed it was. And then when that crashed, that also stressed a lot of retail investors. So certainly understand what you're investing. If it looks too good to be true, it probably is. And you really need to understand how this will function when it gets stressed.